What's up, everyone? It's Scotty with MoneyVest. So in this video, I wanted to break down everything that Jerome Powell said in the press conference from yesterday. So I've had the time to basically listen to that conference not once, twice, and also summarize. These are my entire notes that I'm going to be breaking down. And there's a lot to go over because there's a lot of things that Jerome Powell said that affected the market's expectations, because as we know, the market's pricing in for 6 to as many as 7 rate cuts in 2024. The timing of those rate cuts was also a little bit disappointing because the market's pricing in the first rate cut in March, to which Jerome Powell basically mentioned that he doesn't feel confident that March is going to be the time for that rate cut, or the committee is going to be coming at a conclusion that March could be that first rate cut. It could be later as well. So lots to unpack. And as always, if you enjoyed this video, find it helpful, make sure that you drop a like. I would really appreciate that. And of course, the link to our Discord and Patreon is going to be down below if you're interested in joining. Again, the first week of the month is the best time to join. You get access to over 45 plus private members only videos, access to all the spreadsheets, including S&P 500 valuations. You got volatility cheat sheets, and of course my watch list with my fair values and shopping list, and over 20 plus Discord channels, including all the trade alerts and the buy and sell alerts, options alerts. Everything's going to be included with the link down below. And also do connect with me on Instagram. My handle is going to be CastWRP. Would love to connect with you there. Also, I do post a lot of interesting stories, tips, strategies, portfolio updates, polls. So behind the scenes, everything's going to be over there as well. So link's going to be down below. We'd love to have you on board. So let's start with what Jerome Powell mentioned during the meeting. 2 things. Only 2 things. It was all about achieving greater confidence and getting more data. That's it. The amount of times he mentioned data was insane. For every time, if I bought stock for every time he said data, I would have run out of money yesterday, because he said that word a lot. And he said that we have confidence. We are looking for greater confidence, and we want continuation of the good data that we are seeing. So it's not like they're looking for better data. They're looking for a continuation of the good data that's already been seen over the last 6 months. And they said, we have good 6 months of inflation data, and we want to see more good data. I will be saying a lot of data because that's really what it was at the end of the day. Now, in terms of growth, Jerome Powell said that we've had a strong growth last year, and yet we've had a very strong labor market. We've had inflation coming down, and we don't look at strong growth as a problem. In other words, we're not looking for a weak labor market. So that's actually a little bit of a flip from what he mentioned last year, because last year Jerome Powell said that we are looking for some softening in the labor market. We want that equilibrium between the demand and supply of jobs. And this year, he is saying that we're not looking for weakness in the labor market. Inflation continues to stay elevated, and a lot of disinflation, he said, has come from goods inflation, because good prices have come down. And what we care about is the aggregate number. And as a committee, we just need to see more that will make us more confident moving forward. He also mentioned that almost every participant in the committee believes that it would be appropriate to reduce rates at some point in 2024, as they have already penciled in their summary of economic projections last year in December when that came out, that they are guiding for at least 3 rate cuts, coming down from 5.4 to 4.6%. And again, another SCP is going to come out in March, but they mentioned that we need to see more confirmation, more inflation data that is indeed trending lower. And right now we are in the risk management zone where we want to make sure that we don't move too fast or too slow. So really what they're saying is they're keeping their options open, and they really want to maintain or try to maintain that balance and move cautiously moving forward. And almost everyone in the committee said, Jerome Powell said that almost everyone in the committee is on board with moving rates lower this year, but the timing of those rate cuts will depend on gaining confidence that inflation is indeed on the sustainable path to 2%. Now there were some things that Jerome Powell said that kind of caught the markets a little bit off guard, and that's exactly why the markets were lower. NASDAQ more specifically selling off a little bit over 2%, which I'll go over later in the video. But he again kind of reiterated that core inflation is down significantly from same time last year, and it's likely that it continues on that path lower, and we are not looking for a slide in employment or weaker labor market, even though he did mention that there is some potential for softening in the labor market, and that is something that's welcomed by FOMC, by Jerome Powell, by the Federal Reserve as well. He mentioned that last year that, look, we're looking for an equilibrium. The amount of job openings versus job seekers in the U.S. needs to come to an equilibrium, because that ratio was as high as 2.5, because there was two and a half jobs for every 1% unemployed, and that number's come down to 1.5. And now they're kind of saying that, okay, it's normalized a little bit, and we're not looking for any further weakness in the unemployment or the labor market as well. Now, if we saw, now this is where things get interesting. Now, this is what he says. If we saw an unexpected weakening in the labor market, even though that's not what they're looking for, but if they saw that, then that would certainly weigh on cutting rates sooner. So that's exactly what I've mentioned before. It's kind of crazy because if you go back to my videos and I mentioned that what is the incentive? What is the reason? Why would the Federal Reserve cut rates? They need an incentive. They need to fix something. If you go back, watch my videos, I've kind of mentioned this before time and time again, that they're not going to just wake up one day and be like, you know what, let's just cut rates. It's not going to happen. They need an incentive. They need to fix something before they change or shift or pivot their policy. And this exactly was it. Jerome Powell said that we need to see, or if we saw an unexpected weakening in the labor market, that would certainly weigh on cutting rates sooner. Similarly, very important stuff, he said that if we saw inflation being stickier or staying higher for longer, that would weigh on cutting rates later. So if there's weakness in the labor market, if unemployment starts to go up, if unemployed person starts to go up, that means that they could actually cut rates sooner. And the contrary is that if inflation continues to be a little bit more sticky and elevated above the Fed's target, then that could weigh towards cutting rates later. Very, very important stuff. And they also mentioned that for now, there are no proposed rate cuts. That's another thing that kind of caught the markets a little bit by surprise, because I think the real issue is the timing here, because markets pricing in rate cuts starting March, and Jerome Powell and the Federal Reserve pretty much mentioned that, based on yesterday's meeting, there were no proposed rate cuts. They're not actively considering moving down rates anytime soon. And he also mentioned that we have not yet achieved a soft landing, so we are not ready to declare victory yet because we still have ways to go. And there's risk that inflation could reaccelerate, and that's another thing that kind of caught the market off guard, which I wanted to explain here. He said that there is risk that inflation could start to reaccelerate from here, but there is a greater risk. There is a greater risk that it stabilizes at these levels meaningfully above 2%. In other words, stagflation, which is exactly what Ray Dalio has also mentioned. And, I've mentioned this before, that it's a lot easier for inflation to come from 9 to 3%, but it's a lot more difficult to go from 3 to 2%. And, for Jerome Powell, they also mentioned that they're not looking for inflation to be anchored below 2%. They're looking for inflation to be anchored at 2% while keeping labor markets strong. That's the dual mandate. That's the bullseye that we have talked about in our previous videos. Now, he also mentioned that it would be surprising that inflation starts to reaccelerate from here or starts to move back higher from here. But that's why we keep our options open. That's why they are not, aggressively cutting rates right now. They're kind of going slowly, kind of seeing how the economy responds to such high inflations for longer, such high interest rates for longer. And of course, inflation, what the next 6 months are going to look like. Because he again reiterated that we've had a very strong, good 6 months. Last 6 months were very good, but we want to see where inflation goes for the next 6 months as well. And based on the meeting today, he said that I don't think the committee will be confident to reach a conclusion for the rate cuts in March meeting. And we're going to look at the economic data once again to decide what we need to do. So the bottom line is that, I just wanted to summarize some of the bullet points here from Jerome Powell and from the FOMC. And again, the bottom line is that we are going to see the Federal Reserve play this game where they continue to be a little bit more cautious, more data-driven, as we've already seen over the last 12, 18, 24 months. And again, the bottom line is that, the market needs to readjust to those expectations. That right now the markets are way too optimistic. As I've already mentioned, 6 to 7 rate cuts is definitely a little too high. So if the market kind of reprices that there is disappointment, in my opinion. And of course, the Federal Reserve, 3 rate cuts is possible if inflation continues to trend lower, or if there is a little bit of that spike in unemployment moving forward. So there's your summary. What I'm personally doing in this market environment is not aggressively buying, because I feel like the markets are trading at a little bit of a premium. Valuations are a little too high. So in that regard, I'm not actively looking to buy or dollar cost average into the markets right now, or individual stocks for that matter. I'm simply selling calls, and I'm enjoying as the markets continue to somewhat drift higher to new all-time highs. I'm going to be patiently wait with my cash and be ready to deploy as the markets start to roll over and come down to some reasonable levels where I will be sending out all the alerts. So again, feel free to join our Discord and our Patreon. We'd love to have you on board there. And make sure that you drop a like and, of course, subscribe to the channel. Happy investing. I'll see you all in the next video.